Hello, everyone, and welcome to our webinar on getting good leverage. I'm Megan Schwab, and I'll be your host this afternoon. Our speakers today are Benjamin Lau and Christopher Whitaker. Ben is the Chief Investment Officer here at Apriem Advisors. He has been published in national business publications such as the Wall Street Journal, Bloomberg, CNBC, on sharing his economic and investment views.
Fancy. Good afternoon, folks.
Christopher Whitaker is our Senior Financial Advisor and Senior Financial Planner here at Apriem. His unique hybrid role serves the firm's clients in many facets of their finances, especially on the multi-generational wealth management and client education. And of course, as the title of our webinar suggests, we'll be discussing all things credit, loans, and borrowing today. So we'll go over things like bad debt versus good debt, what banks and lenders look for in a borrower, the differences between fixed and variable debt, and then at the end, we'll be discussing real life leverage scenarios so you can see how those play out in real life in specific situations. With that, I'll go ahead and hand it over to Ben and Chris.
Thank you, Megan. Okay, so first, just a kind of another housekeeping item, just the format of today. What me and Ben wanted to do was we're going to start kind of more beginner, and then we're going to gradually but steadily get more and more advanced as the presentation goes along. So just because we have a wide audience watching today. The other thing I want to say too, before we get started and deep into the material, is especially when it comes to leverage, there is the math of a financial decision and then the emotion behind financial decisions. And debt tends to be right at the juxtaposition between those two things often. And so today we're going to be mostly focusing on the math side of the debt equation. So I understand that there's a whole school of thought that the Dave Ramsey-like method of not having no debt and peace of mind and all those things, and some of that's priceless. I totally understand that. We're just trying to approach it from a more mathematical concept today.
Exactly. Like it's not always black and white, right? It's a lot of times it is a lot of emotional.
Right. Exactly. Yep. And so the first thing we're going to do is just kind of unpack a very basic start, which is bad debt versus good debt, and what we even mean by that, right? And so I'll start by talking about bad debt. And so in our context, bad debt is going to be basically kind of twofold. The first factor is going to be when debt is so large relative to your income that it becomes crushing. Like it's a mortgage payment that you just can't quite handle, and you add on the cars and the credit cards, et cetera, and you kind of get underwater. You know, kind of like the pictures depicting you're getting crushed by too much debt. It's an obvious one, but just want to state that. The second one is more about when you leverage and you buy things that don't produce any kind of income or helpful outcome, which is, I can tell by my foreshadowing tone, to set up for Ben on the good side of debt. So,
yeah, the good debt is, we all have debt, right? A lot of people do have a lot of debt, and I think that there is some good debt out there, right? If you're going to use this debt, if you're going to take on debt and use it for something that's going to improve your life or improve your situation, that's generally okay, right? The biggest one I can think of is education, right? A lot of people can't afford to pay for college up front, and so a lot of people do borrow for college. But that, you're investing in yourself or your child, and that usually is a great investment, right? The other one is usually homes, right? A lot of people can't afford to put in $500 or $1 million in their first home right away as soon as they finish college. So usually using debt, a little bit of debt to kind of give yourself a step up, get yourself started, give yourself a jump start into life can help out too. And even cars. I think a lot of people think car debt is a bad debt, but is it really? I mean, most people here, especially in Southern California, do need a car to get to work. And so as long as you don't over leverage yourself and get a reasonable car, then I think that could be a good debt to kind of help you get to a job where you can get paid.
Yep. Okay. Yep. If only there was a ratio that talked about how much versus, right?
Of course, you got to do the math.
Yeah, exactly. So that's the next one. So we're going to go over some key terms and definitions here. So we're just going to go back and forth. So I'm going to start with something that's called debt to income, or DTI is the acronym there. And so you can tell by the visual there, basically the gist here is that the debt to income ratio formula is recurring monthly debt added together over your gross monthly income, and then that gets expressed as a percentage, right? And so you can see in the simple example we have on the screen, 1,500 plus 100 plus 400, right? And then divided by 6, it'd be about a third, or 33% debt to income ratio. So just coming from like a financial planning perspective for a second, a good rule of thumb, if you were to add up all your debt, ideally is under 36%. That just tends to be kind of where we're at, where we're looking for. Now, from a lending perspective, though, it's a little different. Lenders are going to let you kind of push it a little bit, right? So that's kind of the financial planning ratio. But oftentimes, expected for a mortgage, for example, it's 43%. Sometimes it lets you go to 50% when you add it all up. So it can get pretty, up there. I'm not saying that that's a good thing to do. Absolutely not. A couple of key things though, just kind of some helpful tips. And that's the other thing about the format. We're going to kind of present something and then hopefully give you some takeaways on each topic. And so just a couple of key takeaways in my opinion on debt to income is lenders, because they use this, you're going to feel, especially if you want it, like you want that slightly nicer car, that slightly nicer house, etc. It's really easy to kind of juice your ratio a little bit. And what I mean by that is you can extend the amortization schedules even longer, refinance things, lower the payment, etc., to where it helps your ratio. And it's kind of a dangerous rabbit hole, right? Like this is not a game where you want to fake it till you make it, right? Like this is a game where you want to be more conservative. The other thing is that we're using gross ratios right now, but oftentimes certain debts, I should say, are tax deductible, right? And so that can change the ratio too. So if you're using a gross ratio versus a net ratio, and when we're in one-on-one financial planning sessions and things, we can always make that tailored and more customized to you. The other thing too, I've talked about this in previous webinars. There's a book definition and an investor definition of assets and liabilities, right? And this kind of really plays into that, where the book definition is asset is anything with a value, liability, something with a debt, right? But then an investor definition is an asset is something that produces income and something positive, right? Whereas a liability, it takes away, right? And so that's the ratio right here, right? So if you could add to this and increase it, but slightly a little more income than debt, you could help your debt to income ratio.
That's great. That's great to remember, Chris.
Yeah, absolutely.
Awesome.
Yeah, and just something to add on to that too. I think a lot of people don't think about this formula sometimes uses the average of your past 2 years of earnings.
Good point.
So, your debt to income ratio currently might be 33%, but if a lender or banking institution is looking at those past 2 years where you moved up in your job and gotten a lot of raises, what they use might be a little different than your reality. So it's just something to keep in mind and plan for as you look at your different financing options.
No, that's a really good point.
It seems like a great number you can calculate yourself before you go to the bank, right?
Yes.
Because the underwriters are going to calculate it for you, but
Right.
you might as well calculate it for yourself so you know what you're walking into.
Right, which really quick asterisk before we go next one, just to jog my memory here. You want to be careful too with like some people have either like uneven pay, right, or like bonuses that may or may not happen, right? Just be more conservative. Obviously, it's cliche, but
So you're talking like salespeople, maybe hospitality staff, stuff like that. Okay, that very well. Okay, right. Good to remember.
Yeah. All right.
I have some fun ones. APR and APY, and these really, for our insurance purposes, really talk about debt and credit cards and mortgages. And I think one of the biggest debts that people have out there, especially younger generations, have is mortgages. So when you're shopping around for a mortgage, usually what the advertised rate that you'll see online or in the newspaper is the interest rate on the mortgage, right? And that is right now about 5%, right? It was low as about 2.5% a couple years ago. That's the advertised rate, but that's just what you pay on interest. That doesn't include all the other fees and closing costs and origination costs that you have. All that's embedded in it. And so sometimes when you do a mortgage, you might have to come to the table with a lot of money, thousands of dollars that you might not expect it. And a lot of these lenders are smart, realize that first-time homebuyers don't have that a $10,000, $15,000 check, cash in their pocket. So they'll allow you to roll those fees into the loan, right? And that's the advent of these no closing cost loans or no fee loans. The fees are there; they're just rolled in. So that's why it's important to look at the whole cost. If you roll all those fees into the price of the loan, I think that's why something like an APR, the annual percentage rate, is a much better number to use when you're comparing different mortgage providers, comparing different loan options. That's a huge number, and that's more comparable, right? APY, that's a little bit different. That's not really more for mortgages. That's usually more for car loans or credit cards, right, where it's a daily compounding rate. And so that matters a little bit differently because it's constant compounding. Those are usually a little bit higher. But for credit cards, I use APY. For mortgages, I use APRs. It's probably the benchmark rates to use and make it comparable.
Gotcha. So if I was like trying to do a teaser rate, I would use APR.
Exactly.
Right. Whereas if I was trying to tout high returns, I might use APY.
Exactly.
Right. Gotcha. Yeah. Okay. That makes sense. Okay. So I'm going to cover FICO, which just kind of random fact. So FICO stands for Fair Isaacs Corporation. And FICO is a score that the major credit bureaus use. Really big asterisk before we dive into this, because it's kind of a really deep rabbit hole, depending on how deep we go, right? The first thing I want to say is that this is not the only thing a lender looks at, right? Like your income matters, your assets matter. Your FICO is just one aspect of this. And so with that said, how the scores work. I'll get into the breakdown of the different percentages and things, but as far as the scores go, it's typically between 300 and 850. Anything above 800, as you can kind of see on the screen there, is considered excellent, and it just ranges down all the way to poor, right? And the idea here is that the better your score, the better rates you get. Other thing that might be helpful is anything above a 780 is typically going to get you the best rates at a lender.
It's not the perfect way to judge someone's credit,
no,
but it's how the system is, and it's best that we know how the system is used, right?
Exactly. Yeah, you want to know the rules of the game, right?
Exactly.
And that's, I think, where we're going to be most helpful today. Honestly, is breaking down the rules into maybe deeper levels than most people even realize, and hopefully give you some helpful tips here. I'm going to take it by size of category. So the first one, the biggest one, is payment history. So payment history is fairly straightforward. It is your history of payments, right? And so it's paying on time is the biggest one by far. And so the first point I want to make here is that it's paying on time, and then it's not a linear, like if you're late or delinquent on a payment, if you're delinquent by 30 days is, okay, right, that's one. 60 days is not twice as bad, it's exponentially worse, right? And the 90 days is exponentially worse on top of that, right? So it snowballs the other way in a negative way. So you want to stay up to date on that. The other thing about payment history is there's not a great way to really gain this. Like if you're just starting out, like if you're one of the younger watchers right now, basically the idea here is that it just is what it is, just keep paying on time and build that history up. And then the other thing I'll say is that in this category, really important just to check, right? Because you may think that you're paying on time and have something like an auto pay or something like that, which I think, Megan, you have an interesting story.
Right? I do. Someone I know, they bought their first car. The payment was reasonable. It's something they could handle. And so they just, like Ben said, they set it and forget it. They set their payments on auto pay for the life of the loan. And, you know, this banking institution wanted that last payment to be paid manually. And they did not know that until a year or two later, when they were trying to use their credit score to help them get something else. And they found it had dropped a ton, and there was a huge ding on it. And there's no way of them knowing. So no fault on either party's part, but just a great reminder to be checking your score and making sure things are getting paid on time, or if for some reason something's missed or lost in translation, you can hopefully catch it.
Yeah, and you can do it for free, and just doesn't cost you anything, right?
Yep, it's free. Yep, and that's, yes. There's a common myth I hear this sometimes where it's like, well, if I check, it's going to cost me points. Or no, you can check. It does not cost you anything, both in points and literal monetary costs. The next biggest category is amounts owed. So that's a pretty big chunk as well. That's 30%. This one we can give you some pretty helpful tips. So there's two major components to amounts owed. First one is the credit utilization ratio. That's a mouthful. Basically, the idea here is you add up all of your potential, like your max lines. So like if you have a credit card that's 10,000 and one's 5,000, and there's 5,000, total of 20, right? That's your denominator, right? And then your numerator would be how much debt you actually have taken out across all those cards, right? So if you took out 5,000, you'd have a 25% ratio on that number, right?
Okay, makes sense.
And so the idea here is that you want to pay that down. If you want to be overachiever, you want it under 4%, ideally under 10%, right, of that number by the time the statement generates. So I'm going to say that again, just to be very clear. So I'm not saying carry a balance and pay interest on your credit card. I'm not saying that at all. What I'm saying is credit cards, they generate the statement, and then you have a certain amount of time to pay it on time, right? And so when the statement's generated, that's what the credit bureaus get from the credit card companies. They get reported, right? And so what you want to do, you can use the card as much as you want, right? But if you pay it down under the utilization ratio before the statement generates, keep that under 10%, ideally under 4%, and then go ahead and pay it off on time.
Wait, so you're saying, so for one of our credit cards, the statement date is on the 5th of the month. It's due on the 28th of the month, right? The statement's generated on the 5th, it's due on the 28th.
Yeah.
And I usually pay on the 6th, right? So and so you're saying I can just move it up a couple of days and pay a little bit early?
Exactly, yeah. So, and there's a little bit of a caveat here. So what you don't, if you pay it off too early where there's no balance generated whatsoever, then it's like it's not active as far as the bureaus are concerned, right? So you want, like, you know, I'm just giving an extreme example, $1 to show up on the statement, so it's a use, right?
So they see some activity.
See some activity, exactly, right? But yes, you're right, Ben. So if you just pay that off beforehand, then statement generates small amount, then you pay it off. There's no interest paid, and you're maxing out your utilization ratio.
That's great. That's a great life hack.
So that's, yeah, cool life hack there. And then oh, by the way, too, as life hack, you can usually set those as automatics, to Ben's point, right? You can do percentages or things like that. The second part of amount side, real quick, is the actual amount of debt you have. Now, FICO is kind of guarded on some of these things. They don't give all the math on all these things, so it's a little bit, educated guesses here based on what they do disclose. And so basically the idea here is that you just have an enormous amount of debt, like dollar nominal, then you can get dinged here a little bit too. So just be aware of that. Next biggest one is length of credit history. This one is, now we can take two parts of this conversation. The first one is you're just on your own with no help or life hacks. There's nothing you can do personally. It's kind of a catch-22 because you need credit to get credit, right? And so oftentimes you have this, like you can try and get a cash secured credit card or a small student card. That's the route I went when I was younger. I got like this small little like $250 limit card. And they'll often lend that to people if you don't have that great of an income history or not yet, right? And so there's a way to develop that, but that's what this score is just your length of credit history averaged across your different lines. So if you had one card at 10, one card at 5, right? Like you'd average that out.
Okay.
Right? And so a couple of just helpful hints and tips for this category would be some cards actually let your kid or something like be an authorized user, authorized signer on the card. And if you're a younger person and you're having trouble getting your own card, you could become an authorized signer with your parents' permission, and then now you could build credit that way, right? Again, with the caveat that they have good credit themselves. Otherwise, you're just going to hurt yourself even more, right?
But that's a great way to get our kids started on debt. I know both of us have young kids, and that's a great way to get them introduced to credit cards. And frankly, my introduction to credit cards was when I was in college, right? You got the free little bag and a credit card. And I wasn't great with it. I'll be honest, I wasn't great with it coming out of college. But this is a great way they can kind of teach your kids some good habits right away and co-sign with them.
Oh yeah, it's a slippery slope for sure. The last two categories are a little simpler. So you have new credit and credit mix, and they're smaller categories. They're 10% each. So as far as new credit goes, just a couple of quick tips here. New credit is literally what it sounds like how many lines of new credit do you have? And so the two factor here, right? The first factor is like, are you really asking for a lot of inquiries all the time, like all these new credit lines? And basically the credit bureau says, whoa, wait a second. Chris is trying to open up a bunch of lines right now. Is he in trouble, right? Red flag. And then the second topic is, as far as new credit goes, is it goes back to what we just said. If you open a new line, it lowers your average, right? And so you got to be careful about how often you open those, right? Last one is credit mix. And credit mix, again, is only 10%, but it basically, it kind of rewards you if you have different kinds of credit. So if you had revolving credit lines, which is like credit cards, a gas card, etc., then you had a mortgage payment and a student loan and like all those kinds of things, right?
How about utility bills?
I don't think so, actually.
Okay.
Yeah. And so you put those together, and then you get rewarded for paying those on time in a good manner, right? And just one more asterisk here. I'm not saying to go out and get a bunch of different kinds of loans. It's not worth it. It's just saying as you go through life, it's actually a good general thing to finish this slide on is just as needed. That's when you pick up credit and you manage it responsibly.
And I just want to add on to that real quick, as someone who's recently gotten out of college, just kind of confirming what you say, Chris, and try to live with little to no debt. But as I've needed a new car or using a credit card to get travel points, it's become very helpful, used responsibly, and then I'm able to mix up the credit a little bit and establish different types. So it's certainly possible, and I don't think you have to try very hard to establish that good, healthy mix of different types of credit.
Yeah, it's just a tool. It's a helpful tool to have in your bag.
Exactly. Right? So I'm going to finish up some of the definitions here before we get on to some of the scenarios, okay? So some of the basic stuff here, I think we're just finishing up. Really, again, talking about mortgages specifically, but various types of debts. There are a couple terms, right? The first one is really fixed versus variable rate debt. The fixed rate debt is traditionally what we think of, most people think of mortgages, right? A 15-year mortgage or a 30-year mortgage where you're locked in. You start a 30-year mortgage today, you're locked in for the next 30 years at say 5%. You know that rate's not going to change, right? Versus a variable rate mortgage, or what many people call an ARM or adjustable rate mortgage. Those are a little bit different, where you're not locked in for the whole length of the loan, but you're locked in for a specific period of time. And so a common one may be a 7-1 ARM. Okay, and let's break those. Sounds like let's break it down a little bit. A 7-1 ARM means it's locked in for the first 7 years, and then that's the first number. And then the 1 number means it's going to adjust every year, 1 time a year. Okay, so it's locked in for 7 years, maybe get a bonus rate, and then adjust every year after that. There's could be what maybe a 10-year 6, right? And so a 10-year 6 is a 10-year locked rate, and then it adjusts every 6 months after that. And so that's what the terms are, man. So the terms can adjust, but they're also subject to floors and caps too. They can't just completely raise your interest rate by 100%, right? There are floors and caps on what they can raise it to. But those are very interesting. Those are very interesting mortgages. In the past, I would say 10 years or so, really since the great financial crisis, the market has been gravitating more towards fixed because interest rates have been very low since the great financial crisis. But before then, ARMs were very popular, right? It allows you people that maybe were thinking about not staying in their home for a very long time. Maybe it was a flip, or they were going to live there for 2 or 3 years before they're going to move. So that's where ARMs were very popular, right? People that weren't going to stay in there for a long period of time. And so those are really popular. I think right now, and we get this question a lot, right? What do we do right now with interest rates so high and where mortgages have been? You have to look at it. You have to shop around a little bit, and we'll get to that a little bit. ARMs are very interesting because when the yield curve is steep, we talked about this in some of the economic webinars, when the yield curve is steep, when low rates are very low and high rates are higher, ARMs might be a better option because you're borrowing here versus here. And then when the curve is flat like it is now, fixed rate mortgages are a little bit better. Right?
Because you'd expect the curve to steepen again at some point.
Exactly. So there's a couple terms there. And so let's use those terms and kind of going through for our first example. Let's start with the real basic stuff right here, okay? This is a first-time home buyer. This is Mr. Frank Sample here. Mr. Sample is 33 years old. He's doing pretty good, by the way, right? He's got a good plan. He's obviously met with Chris and Megan to talk about the plan he's going to save for retirement here.
It's all us, not that.
I know this because Frank's making good money. He's making about $120,000 a year. He's doing great for 33 years old. I know he's meeting with Chris and Megan because he only spends $50,000 a year on expenses, right? He's spending less than he's making. So that's a great sign. You can see on the right-hand side of the chart, that's really his financial plan, right? If Frank just continues this track here, he doesn't own a home, doesn't do anything yet, he just rents, and this is his graph, he's going to do well in the future. He's going to save a lot of money.
So just to be clear, so each bar, 1 calendar year.
Okay.
X-axis goes out to age 95 in this scenario for Frank. Y-axis is the cash at like the liquid assets, like stocks, bonds, cash, that sort of thing, building up on the graph over time. And it's a big number because he's compounding for 60 years,
exactly.
More than 60 years on that graph.
So he's doing well.
Okay, got it.
Let's say Frank wants to buy a house, right? He was tired of renting. And so he wants to buy a house. He found something probably not in Orange County for about $600,000, okay? Which is lower than the average price in Orange County now, right? But, down payment, he's going to do the traditional way. He's going to put 20% down, or about $120,000. So he saved that. He's going to put the $120,000 down. He's done a great job. So he's going to take a loan out for the balance, right? $480,000. The current rates right now for a 30-year fix are about 5%. That's the market rate, plus or minus a little bit. And as I said, he's doing it for 30 years. And so his monthly payment, if you just do the amortization of principal and interest, is about $2,577. And remember, we talked to the debt to income ratio that Chris was talking about. Okay, and he's making $120,000 a year. That's about $10,000 a month. His monthly payment on this mortgage is about $2,500. So his DTI is about 25%. So that's kind of the numbers we're thinking about here. Pretty good DTI. Okay. Don't forget though, there's other things that Frank has to be accountable for now. He's got property taxes, potentially Melrose if he lives in a New York property, homeowners insurance, HOA. Now he's not renting. He bought this property. Does he have a garden? Does he have a pool? And all those utilities that come with a bigger property. The fun stuff of home ownership, right? But he's doing well. You can see here on the graph, he's lost some value on his liquid estates because he's taking that money. He's taking that $120,000 and invested into his house. But he's up towards his debt, right? And so he's lost a little bit of value there, but he's still on the net worth, he's still doing pretty well.
Right. Yeah, still has the home.
Right? He still has the home that's growing in value, right?
Yeah.
So what happens if he doesn't have the 20% down? What happens if he wants to do something a little bit differently?
Let's see.
So for a lot of first-time home buyers, you don't have to put down the 20%, right? There's government programs that allow you to put a lot less down, and in some cases you can put as little as 3% down, which is a big difference. That's a huge difference for first-time home buyers. And so same property, $600,000, not Orange County again, been putting out 3% or $18,000. Okay. And so he's gonna have about $102,000 in excess cash because he didn't put all that down. Okay, so let's put that aside. Let's put the $102,000 aside for a second. If you don't put down 20%, most mortgage companies will have you get a private mortgage insurance to cover in case you do lose that. So in this case, it's probably about $150 for the first 10 years. So you have to add it into the cost of the loan. So let's take it down, okay? And so say Frank does borrow a lot more. Next slide. He borrows $582,000, right? He puts down $18,000, borrows $582,000 at an interest rate of 5%, same rate in 30 years. The payment on just the mortgage is about $2,975. But when you add in that principal, but that mortgage insurance, that brings his total payment to $3,124. Okay, versus the $2,500 that we're talking about in the previous example. Okay, so this is interesting. So look, his monthly payment goes up. His monthly payment goes up about $600, right? So he's paying more a month, but he doesn't have to come up with a huge nut of the $120,000 to put in the house. That gives the opportunity to invest that money. And if he's investing in a pretty conservative, balanced portfolio, or even must be more aggressive, that can earn a lot more money, and there's a lot more opportunity cost he has with that. And that's about $1 million.
Yeah, depending on conservative, yeah, exactly. I think we have a very conservative rate. So
yeah, so he's going to grow that. He's going to borrow more, but actually put that and invest in the portfolio and actually see a nice gain in his net worth.
So just to kind of try and so what I heard was you don't have to do the conventional. The risk is you have a higher DTI, right? Because now we're at 31% DTI just from the one mortgage, right? Plus whatever else is happening in Frank's life. But if he does something productive with the cash that he has, then it actually ends up being, I mean, I'm just gonna, looking at first slide here, right? 3883, 3814, it's very similar.
Exactly.
But he has to be productive with that cash.
It does.
Okay.
It gives a little more flexibility, and but you're right. He has to be more. He has to invest the cash in a proper way, and he has to watch his other budgets too, right? Because now his DTI is 31%. Does he have a car loan? Does he have a student loan? Does he like to eat out a lot? Like he's got to worry about those expenses, and does he want to have that? But it's much more far away for a lot of people to get into their first home. But there's some sacrifices too.
Yeah, makes sense. All right, so our next scenario, this is a pretty common one that I get a lot in financial planning situations. So just setting the stage again here, this is Dave and Deborah sample, 51 and 52 respectively. You can see their retirement's about 14, 13 years away. Between the two of them, they make a solid income. Expenses there you see. And then what's interesting is, they got their first home in their 20s, and so they're kind of coming towards the end of their amortization schedule right now.
Okay.
So someone comes in and says, hey, Chris, I have a little bit left on my mortgage here. Should I pay it off? But then it feels like I'm going to have a bunch of dead money there. So should I cash out, refinance, and do something productive with it? I've thought about doing a vacation home, actually. All these different scenarios that come up, right, all the time. So before I get into that, we're going to go over some of those scenarios. I just want to point something out. If they didn't do anything, that's the graph, right? So they're perfectly fine. They can just ride off in the sunset if they didn't want to do anything, and their plan is solved, right?
Yep.
But leverage can go good or bad, right? And so we'll start with the positive scenario here. So in this scenario, they took out $450,000 on their primary. Again, they just did a 30-year normal fixed term at about 5%. And then they chose to do something productive, financially speaking. So they bought a rental property with $300,000 of that $450,000. So, they did a home value of $600,000. They used $300,000. And basically the way that works out is we just put it to where the cap rate's decently high, to where the cash flow from the rental income is covering the mortgage. So someone else is paying that, right?
Okay, smart.
They're also getting tax deductions now across the board, just kind of a quick side note, right? In this scenario specifically, now all of a sudden you have now your loan is tax deductible again on your primary residence, right? So that's on your Schedule A. And then now you have a Schedule E with your rental property, and all those things are being run through your rental property. That's all tax deductible too. And then on top of that, you have rental income at a fixed rate. So over time, that rental income goes higher and higher and higher, right? As you would, hopefully find good renters and keep charging more over time, right? And then they still have cash left over. So they have $150,000 in this scenario where they're able to put into a brokerage account, just invested in a balanced type of portfolio, getting nothing crazy, just like a 6.6% return, right? And then when you add all that up, they just have positive after positive after positive, and it adds $2 million in today's dollars onto their projection. And that $2 million is either extra retirement money or more inheritance for their kids, or it's third generation, right? Dynastic wealth here. right? And so all these things that can happen. And so that's the positive aspect of leverage. Now, with this next one, what if they didn't do something that produced more income, more assets, et cetera, right? So this one, they decided to take it out and live it up a little bit so their expenses increase. Then they have that same 5% 30-year loan at $450,000. And then they buy a vacation property, not a rental property, vacation property. So now they're just carrying an extra mortgage and all the expenses associated with that, right? And you can see on the graph, it ends up being this kind of downsloping trend here to where they don't have much liquidity left at the end in their 90s, but they do still have obviously the homes for inheritance purposes. And so, hey, I get it. Some people want their last check to bounce, and that could work, right? That could be I said unsuccessful. Maybe that is success for you as you're watching this, right? You want that kind of sloping down curve, and I get that too. But if you wanted to grow wealth, that's not the way to do it. Right? Yeah. Is the point here.
So, and you're not liquid, right? You have a lot of upside in hard assets.
Exactly. Yeah, exactly.
So number 3 is a little more unusual, right? And this is really, I think, come across probably more popular in the last 10 years or so since the great financial crisis. And it's not just borrowing against other real estate, but borrowing against your other assets, and namely your portfolio assets, because a lot of clients have seen a 10-year bull market, and they've had a lot of investments in their trust accounts or taxable accounts that have grown in value, and now they're at low cost basis, and we need to talk what to do with it. Mm-hmm. So let's talk about the same example, right? Harry and Wendy. Harry's 64, Wendy is 63. They're retiring very soon. They have a nice income. Decent living expenses, but they spend about $300,000, so healthy. And they have about $2 million in a balanced portfolio, right? And in a taxable balanced portfolio. Okay. And so let's start with that. The bars on the right-hand side, they're doing great, right? No issues there. I think they're obviously are an Apriem client. The type of loans that we're talking about, some people call them margin. You can do the margin on a brokerage account. Those are pretty traditional way. That's been around forever. The newer ones are called securities-based lending, or in Schwab's case, they call them PAL, or Pledged Asset Line of Credit. Very similar to margin, but more on the banking side of things with different regulations. And so what they do, for this case, they transfer that brokerage into a PAL, like they convert it into a PAL account here, and then they borrow against it. And generally speaking, you can borrow against 70% on your stocks, a little bit more in bonds, a little bit more in bond funds, but you can usually borrow about 70%. So we assume here about 75, you can borrow about 75%. So they're about $1.5 million and put it into a new business, a nice asset, a nice cash flow producing business. This business is making money. It has revenues about $500,000 a year, expense about $200,000, so you're netting about $300,000, right? That's great. 70% of the profits per year, and the PAL interest rate is about 3%. The PAL interest rate is like almost like a HELOC. It's a variable rate of interest, usually based on, in the past it's been based on LIBOR. Now it's based on something called SOFR, or the single offer financial rate. And so that's really low, but that's right around 1% right now, plus a little bit of a spread, right? And they're going to pay back that credit line in the next year. So they really want to pay that back. But look at their plan. It really does well, right? They have a nice case. They took out some leverage, a modest amount of leverage on the portfolio, and invested in a revenue producing vehicle, and that really helped their retirement. It's even better.
I mean, this graph isn't even counting, just as a financial planner, my mind's going to the estate planning side of this, that if they live in a cost basis step up state, right? Mm-hmm. Now they've borrowed against it tax free, didn't realize the capital gains, and then when they pass, step up in basis, now their kids have even more inheritance, right?
Exactly, and especially, and when you talk about all the taxes involved, right? The PAL interest is about 3%. That's about what, $45,000-$50,000 a year. Maybe right. You can use that to offset some of the business revenue, right? Use that as a deduction. Got it. And it still allows you, depending on what you have in your portfolio, what happens if you have the Amazons and the Apples that have done so well for the last 10 years? Do you really want to sell that and pay the capital gains on that? Because even if you sell the $2 million, you're still going to get about 1.5 after taxes anyway.
And I imagine you could try and make it somewhat revenue neutral too, to where you're producing dividends and interest to help offset some of that, right?
Exactly. Yeah. And you get to keep your holdings too, depending on if you like them or if you inherited them.
Right. So, what's the downside?
Well, the downside, like anything we've talked about, it seems like the downside is just too much, right? Wanting your cake and eating it too, right? And sometimes that just gets a little too greedy here. And so same situation that Chris was talking about a second ago. Let's not use this, let's borrow some money, but not use it for a revenue producing asset or cash flow producing asset. Let's go buy to a nice vacation home, right? Or a brand new home. And so they transferred $2 million into a brokerage account. They still borrow the same 1.5 to purchase a new home, and they still pay the 3% interest rate. But if they're not producing any assets, they're just paying that $50,000 in interest out of their pocket, and that has a dramatic effect on their plan, right? You can see on the bar, the bars go pretty quickly down. That extra cost just eats away at it, right? And generally speaking, it's not just that. There's other costs involved in the house too, right? Like, moving costs and stuff. But the cost of it is just surely eats with the liquid portfolio. You have a nice asset in the house, but your liquid portfolio is really getting hit on the right side of the graph here.
Got it. And then for the last scenario, what we did was, it's a little more complicated. So so basically this is a leverage assets for income. So this is one in the very beginning, I said, FICO is a very nice tool to have in your back pocket if you really need it, right? Good credit.
Mm-hmm.
And so this is a scenario where someone is approaching retirement. They still have a few years left, so you can kind of see the graph. They're still saving, right? So they're 57, but they're retiring at 65. So they can still save a little bit, but the amount that they can save isn't quite enough to cover their current living expenses, right? And it gets a little dicey towards the end. But they do have this lovely home valued at about $850,000 and a decent amount of equity inside of it, right? And so the idea here is that you can use that hard-earned, well-managed credit to kind of salvage some of their plan here and keep their living expenses the same. And so what we did was we created a home equity line of credit, and there's lots of different ways to borrow against homes. I'm just picking a HELOC, but we could talk about other ones too. But we're just picking a basic revolving line, home equity line of credit of $200,000. And basically we're using the line strategically for income, and you're balancing this out. So this is not something that everyone should do, just to be very clear, right? This is a way to use all the assets available in a plan and balance the volatility. So there's something called sequence of returns risk for those that haven't heard of it, where basically if the stock market tends to be down and you pull out a fixed amount of money, you're selling more shares and a higher percentage of your portfolio, and you have a chance to run out if you do that too much.
A big risk for retirees.
Exactly, it's a big risk. And so what this does is it allows you to leverage all that equity in the house. So when stocks are way down, you pull and use some of the equity on the home side, let the stocks breathe for a second, don't sell any of your shares, the stocks rebound at some point, and then you can turn around and flip that back and pay off some of the line, and or just stop drawing on the line, right? And so you mix and match the different asset classes, and it ends up creating this nice little teeter-totter effect, balancing out volatility. And again, this is one of those ones where don't try this at home, like truly, like use an advisor, whether it's us or someone else, because you want to be really careful when you enact these kinds of strategies, because it can be dangerous.
Yeah, seems like a lot of good options out there, but you really need to have a plan.
Yes,
to tackle this.
You need a plan, because you're taking on debt and then spending that debt, so you have to be very careful with the balancing act. And just saying, this is there's several that I can think of off the top of my head where this really did save people, especially during the pandemic.
Mm-hmm.
I have a couple that just stand out in my mind where they had this scenario and stocks plunging, depending on how aggressive they were being, right, in their accounts, and then enacted this kind of strategy, stocks rebounded, and it really saved their plan. So it can be powerful.
I mean, a lot of people think of debt as a negative thing, but I really do think of debt as almost like a lubricant, like a grease, right? It makes things a little bit easier. It's not great to have it all the time, right, yeah, but it makes just things a little bit easier. When you buy your first car or go to school, yep, it makes this things a little bit easier.
Absolutely, absolutely, yep. And with that, we'll open it up for Q&A.
Our first question here is for Ben. Where do you think interest rates are going now, and what types of strategies would you deploy given today's macro environment?
That's a timely question, right? So I kind of want to answer this in a couple of, it's a long answer, but I'm going to answer it a couple of ways, right? First of all, we've already talked about there's a couple of rates out there. There's your shorter term rates, like your checking account rates, adjustment rate mortgage rates, and then longer term rates, like fixed rate mortgages for 15 and 30 years. Right now, it does seem like the Fed is on track to continue to fight inflation, right? Given everything we talked about with Ukraine, we talked about in our market rates. If you met with us, you talked about Ukraine, the supply situation that we're having, and the supply chain issues we're having, high oil prices, inflation is clearly on the rise and has been rising. And I think the Fed is clearly looking to squash that, to get that under control. And I think they're on the path, right? 50 basis point increases for the next 3 meetings takes us through summer. I think short-term rates are quickly approaching 2%, 2.25%. I think that's what we have to plan for when we do these financial plans. Longer-term rates are still going up. You know, as we talked about at the beginning, mortgage rates were about 250, 275 for 30-year fixed not that long ago, and now they're touching 5. I don't know if that can go much higher. I really don't think that it's going to go up, 200% like Fed funds rates are going to go, but I think it's still going to gravitate maybe 50 basis points higher from here. I think the trend is clearly higher here. So what do you do? Right? What happens if you locked in a fixed rate mortgage? Great, I think you're sitting. If you were to refinance 2/3 of Americans have a home, and I think a lot of them are refinanced. I think you're sitting pretty. I think you've done a lot of good things there. But what if you haven't yet, or maybe you're thinking about taking on new debt? The first takeaway is clearly just shop around, right? There's a lot of options like there, kind of like what Chris has been alluding to. There's some unconventional ways of getting financing and getting debt. It's shop around and know your options. Talk to Chris, talk to Megan. Megan has some experience in the mortgage business, right? And so she's a great resource to have here at Apriem. And so look around and look at some non-traditional ways, okay? Number two, shop around. This has been a big change since the great financial crisis. Big banks are no longer the major lenders for mortgages. They're non-financial companies that are the big lenders right now, right? I have not gone to BofA or Wells Fargo to get on my mortgage. Every time I refinance, it's through like a Quicken, right? What Schwab uses.
United Wholesale.
Yeah, United Wholesale, Mr. Cooper, Loan Depot, a local company called Better.com has really been popular here. They have different financing mechanisms, right? They might do securitizations, they might get wholesale lines of credit. They're not like a major bank. They have different motivations than major banks do. And in a lot of cases, they're much more competitive than the Wells Fargo's and the BofA's. Shop around, look around, do go on the Google devices and look for better rates, right?
And to add on to that real quick, sometimes you can even take the quote you get from one lender, you know, and use it to get an even better one from someone else. So
it pays to be competitive, right? It's a competitive market out there, and shop around. And so, and again, look at APR. Don't just look at the rate. Look at the APR. What kind of fees are being hidden into the mortgages, right? Again, obviously, we talked about just rate mortgages and fixed. Right now, we talked about the yield curve, and we talked about how flat the yield curve. The difference between short-term rates and long-term rates isn't that much. It's about 30, 40 basis points here, right? Less than 0.5%. And so look at other options right now. When the yield curve is this flat, fixed rate mortgages are usually pretty good, but the yield curve steepens a little bit. Take a look at some ARMs, you know, take a look at all the alternatives. As for one of my last examples, the pledged asset lines of credit, right? These securities-based lending models. Take a look at your collateral mix. Don't just willy-nilly go into something and borrow. Well, I have $1 million portfolio. I'm just going to borrow 70% of that. Take a look at your collateral mix. Take a look at the volatility, the risk of your portfolio. Is it a lot of tech stocks? Is it all EV stocks? Or is it all bonds and a balanced portfolio? Take a look at it. Take a look and make some wise judgments there and how much you want to borrow. Because you can be, you know, with the market falling 10 or 20%, you can be really subjected to any declines to market value. So pay attention to your collateral, and we can always help you with that too.
Because then you're saying you get a call, basically, like a capital call, essentially.
Yeah, if you don't post enough collateral, or if your collateral falls in value and borrowed up against to it, then yeah, you can have a margin call or a collateral call, and then you'll have to post more collateral, right? And that's the last thing you want to do in a declining market.
Yeah.
And the last one is pretty much a basic one. I said this last because we don't have a lot of clients that are affected by this, but for clients that use margin or use these kind of these asset-based lending programs, take a look at what your rate is and how they're calculating that rate, right? The current default for Schwab, if we just take some margin loan, it's about 9%. The base rate, as we call it, is 9%. It's really high. It's a standard rate, right? And so what we do, what Apriem does when we negotiate with other providers, is maybe change that rate, get a lower spread, and maybe use something like LIBOR or SOFR as the base rate instead to compare it. And so that can get your yields down quite a bit. We change that reference rate down to a more reasonable reference rate. And for that place, there's a lot of SOFR or LIBOR or even Fed funds is a good way to do that.
let's see, another one we have here is a home equity line of credit better than a cash out refinance? In what situations would you choose one over the other?
Wow, tough one.
You want to
Chris.
hear me?
That's all you.
Okay. I was like, can you say it one more time, Megan?
Is a home equity line of credit better than a cash out refinance? In what situations would you choose one over the other?
Okay, so what I would say is there's no, there's a gray area here, right? And so I'd say when rates are very high, then a home equity line of credit would be more attractive because you're not worrying about locking in a very high rate for a very long period of time, right? Kind of like what Ben's been alluding to with some of these ARM deals and things like that. Whereas if rates are very low, refinancing and even cash out refinancing makes a lot of sense, right? Because then okay, so especially when you're talking about investing and trying to improve your overall financial position, it's not perfect math, but there's just kind of a rule of thumb I use in my head. Whatever debt you're taking on becomes like a hurdle rate essentially, right? And so if you're borrowing at 3% or 3.5%, it's not too difficult over a long period of time to get above 3.5%. And so I would take that bet all day, right? If it, if mortgages keep going up like maybe it goes to 6, 6.5, et cetera, it gets a little harder. Now you're having to take on some serious risk in terms of equity markets and things to be able to beat that long term. Maybe that's not worth it, right? And so, yeah, I would say, and then one more caveat to this is from a tax perspective, maybe you get a little bit of a bonus. Like, so if you're doing a cash out refinance, there's an additional incentive there too, because maybe you're at the end of the amortization schedule and it's not even deductible on your Schedule A anymore, right? And then maybe that's the difference maker in terms of it being deductible or not. Right?
Mm-hmm.
So,
regarding leverage, what exactly is a leveraged ETF?
Oh, that's an interesting question. And so, yeah. So we're talking about getting leverage. We're really talking a lot in this webinar about leverage and talk about real estate, right? If you only have, in my example, is $120,000 and you want to buy a $600,000 property, you're leveraging, that your cash by $100,000 to buy a property that's 5 times greater than that, right? For $600,000. That's kind of the same thing with these ETFs, right? ETFs will say like a simple one like the S&P 500 index or the spiders. There are products now that will give you when they've been around for a while, twice the leverage on that, or twice the returns on that. Okay, and so if the S&P did 1% today, this ETF will do 2% on a daily basis. If it was down 1%, it'd be down 2%. So it cuts both ways. And so they use usually derivatives or derivative contracts to get that exposure, usually by big bank, and it's a way to juice returns, right? The biggest caveat is that when you get more leverage, it only matches up on a daily basis. So there's something called time decay. So the longer you have this, you're not getting the returns, right? If the market is up 5% in a week from Monday to Friday, you're not necessarily getting exactly 10% or 10%. You're not getting double that return. There's a decay that happens depending on those sequence of return risks that Chris is talking about. Yep. And so you have to be really careful of that. And so they can happen on the upside and the downside, but they're getting very popular, and it's very interesting.
Because the average is misleading, is what you're saying, right?
Exactly, the averages are misleading.
Got it. That's interesting.
And so, say if you started and the S&P was down 2% right at the beginning, then you're already down 4% if you're leveraged, because it's hard to hold a climb out of.
Yeah. Would you rather, if you wanted to take on leverage, Ben, would you rather use a leverage ETF or just your own forms of leverage? I guess that's a loaded question.
Yeah.
It depends.
If I were to execute a trade, that's a short-term trade, kind of like, we talked about some of these options. I think these leverage ETFs and options make it interesting way. But if you're in a hold for a long term, I think these leverage ETFs are probably not the best because of that decay factor that happens. Right? I would just rather own S&P 500 or the index fund or Apple or Amazon.
Long-dated options.
Yeah.
Or something like that.
Yeah. I mean, and truth be told, these leverage ETFs, they get sold really improperly, right? They're kind of an area, a gray area of the market that the SEC does watch for, because inexperienced investors can blow themselves up pretty quickly in this kind of area. And so we're very cautious of that, and frankly, we don't use that for any of our clients.
This person's asking, I have a lot of equity in my home, mostly due to the real estate market being hot. Given the equity market is down and there's a lot of bargains in the market, do you recommend me refinancing or taking a HELOC with, to invest that cash in the equity market? Does that make sense every time the market's down? Or are there times when I shouldn't do that?
Yeah, I would say to this person, let's please schedule a financial planning session if you're seriously considering this, because as you can see in all those scenarios, right? Like there's a lot of other nuance and factors that go into this. But in general, if you have positive, solid cash flow and that's not too much, and it could become tax deductible, yeah, I mean, the bottom line is it can make sense to do that. Now, unfortunately, rates are very high, but we could look at different ways to finance it depending on your portfolio and the real estate entity itself, right?
And how much leverage you have in general.
Exactly. Yeah. What's the other leverage that you might have in your estate, et cetera? If it's the only loan that you would have, well, it's probably fairly easy to cover. So yeah, it could absolutely make sense is the short answer.
This next one is, where can I find my credit score? And is there a bureau that is better than another? I can go ahead and answer this.
Yeah, I was gonna say, you answer me.
Yeah, so there's 3 different credit bureaus: Equifax, Experian, and TransUnion. Each bureau, you can set up an account for free and check it, as frequently as you want. Your financial institutions, wherever you're borrowing this money from, might depend on a different one for lending purposes. Your score might vary because they all calculate it, in their own way a little differently. But yeah, one of those 3 is a good one to go to. And personally, I check mine every month just to see where it's at on Experian. And it's just really helpful, keeps me up to date.
Nice.
Yeah.
Good tip.
Let's see. The last one. If I already have a lot of debt and want to purchase a home, what can I do to free up some cash flow?
Yeah, it depends on what kind of debt you have, right? And a lot of the times it does really start off with just coming with a budget and number one, stopping the bleeding, right? And make sure you're not incurring more debt at this point, maybe get things under control and work on the plan. Depends on what your situation is. If it's a lot of credit card debt, maybe just look at some consolidation and set yourself on a path to buy your first home, right? Because it's not going to be an overnight fix, but there are some things you can do over a course of a period of time to get this, and really, talk to us, right? We can really help you with that debt counseling and kind of coming with a plan to get you on your first home.
Yeah, no, big ditto on that. Just come up with a good strategy, a good debt plan, something, that's where, I guess we're coming completely full circle to the beginning of the presentation where like the Dave Ramsey method and things like that, like there's a reason why those things work emotionally, give you small wins, like the snowball effect, right? All those kinds of things. It might not be the most mathematically concrete thing in the world, but it works.
It does.
Like from an emotional and human perspective. So that can be pretty powerful.
Yeah.
Great. Well, thank you both for your time today.
Thank you, Megan.
Yeah, anytime. Those are all the questions we had today. Thank you so much for joining us, and we'll see you next time.
Thank you.